Hey guys, Drew here, and welcome to the Engineering Success YouTube channel, where each week I talk about different personal finance topics. If you're interested in that, make sure to subscribe so that way you don't miss out on any new content. In today's video, we're going to be exploring the idea of growth investing. To get started, growth investing focuses on capital appreciation. Basically, this is where you're looking for a company that is going to grow in value over time, and as it grows in value over time, it will have appreciated in value, and then when you sell that stock at that time, you will have made money off of it. That's generally what a person is looking for in investment when they're coming at it from a growth investing standpoint. Generally speaking, growth investors are looking for small, up-and-coming companies, and oftentimes this will be looking in industries that have a lot of future growth or that are somewhat speculative but are in expanding industries with high growth potential. Good examples of these would be like artificial intelligence, fintech, MJ stocks, biotech, things like that. And the reason that people go after them is because they see that they could have exponential growth curves relative to a normal bigger company that you would invest in the S&P 500. So when a growth investor is looking for a stock to invest in, there are certain things that they're going to look for that are different than, say, a value investor or a dividend investor. And I've whittled those down to three basic ideas. There are of course others, but these are the three main that I use when I'm looking for a growth investment. The first is a growth story. Basically, think of this as, it's very subjective in nature, but what you're looking at is, do I see this growing market share? And a good example of this would be like EVs. Tesla for a long time wasn't making any money, but people were still investing in it because they could see that in the future it's going to have more and more value because electric vehicles are going to gain more and more market share, and ICE vehicles are going to end up becoming more and more obsolete over time. That would be an example of a growth story. Now, I don't necessarily know that that is 100% going to be true. EVs could end up falling by the wayside with other technologies coming forward, like hydrogen fuel cells, but that would be an example of a growth story when I'm trying to just come from the outset of, is this company in general, without looking under the hood, is this company in general, is the philosophy, is the idea something that I can see producing a lot of growth? The second thing that I look for is earnings growth. Oftentimes early on companies will lose money or not make that much money because the earnings they do have, they will often take and reinvest back into the company, so they won't have as high of an earnings per share that year, but that doesn't necessarily mean that the company is not successful. It's just that they're building more towards the future and trying to invest in that growth. So what I like to see is when I'm looking for a good investment in a growth company, I want to see that their earnings are gradually going up each year. So I generally want to look and see, their earnings chart or their earnings per share chart. I want to see that, steadily going up. And if it's not increasing, then I'm going to have to look a little bit deeper to understand what is management's direction, what's going on here. And it doesn't always have to be earnings per share, but I really prefer that because I like to see companies that are already able to make money, or at least are getting better at making money over time. I'm just not someone who's as risk-seeking looking at companies that, don't make a profit yet. EPS, which is earnings per share, is just one aspect I'll look at. If maybe earnings per share doesn't give the full picture, another thing to look at is that their debt to asset ratio. I want to see their debt to asset ratio getting lower at least each year, because that means they're not as over leveraged, so they'll have a much better chance of surviving in the event of a economic or industry downturn. So that's another thing to keep in mind. And then I also like to look at revenue, but the one issue I have with revenue is revenue is not, in my opinion, the best indicator, because oftentimes a company can increase revenue each year, but they're taking on more debt or their operating expenses are also increasing each year. And if I'm not seeing the revenue outpace the operating expense growth, then that's not a good sign for me, at least as an investor. I want to see a company that's profits are growing while their costs are stabilizing, relatively speaking, or shrinking. Another thing to look for with earnings growth is return on equity. So return on equity, or ROE, is a measure of profits relative to invested money. So basically you're looking at the money that investors have put into the company. You're looking at what the profits are relative to that. You generally want that to be higher. This shows that the company is better at managing the funds that they have available to them, and that is a good sign for future growth. As more investors put money into it, that the company is able to use that money and deploy it in a way that helps the company grow. And the third thing I look for with a growth stock is scalability. Generally speaking, this means I want a company with low fixed costs relative to variable costs. To give you an example of what I'm talking about, an airline is a very capital intensive business because you need to have very large, expensive assets like planes and airport terminals. Those cost money just to operate, whether you're getting business or not. I don't generally want to look at growth companies that are capital intensive. That's why software companies are such good growth companies, because you want a company that has very low fixed costs, meaning that their asset costs are not that high, and then they're able to, as they grow customer share or they scale up in volume, they don't have to increase those fixed costs so much. This makes them a little bit more agile. So then when you're in a scenario where there's an economic downturn and say business goes back down, you're not still saddled with paying for all of that fixed cost. Instead, you're able to adjust with the times. This means that the company is less likely to have to take on debt during economic downturns. So it makes it a little bit less risky of an investment. And then another thing that's extremely important is moat potential. So moat in the corporate world means an ability for a company to protect its market share. So what you want is a company like, say, 3M or Johnson & Johnson. These companies have very large moats. They have such diversified product lines that it's very hard for them to have all those product lines hurt at once. This makes the company much more stable once it's established. But when they're growing, what this does is it gives opportunities for that company to grow in many, many areas. Think of, say, back to our example of Tesla. So Tesla, people look at it as just an electric vehicle company. That is not as attractive of an investment to me because someone could come out with another electric vehicle that could be competitive. I don't want to predicate my investment all based on one specific type of product. But because of Tesla Solar, because of the batteries they're developing, which I think other car companies are going to end up having to buy from Tesla, that means that they're going to have a better chance of not having to worry about competition, or at least profiting off of competition. Then on top of that, when you think of robo-taxis in the future, you see a lot of areas where that company can grow and spread out. Amazon's another great one because it's such a simple, diversified platform. They can get into pharmaceutical delivery, and that could end up hurting companies like CVS or Walgreens. And so things like that are what you want to look for with a growth stock. You don't generally want a stock that is so focused on one specific thing or product, because it's less likely for that company to grow exponentially when they only have one shot. I want to see at least a few different areas where that company is able to expand into. Now, all that sounds great, but here's the thing. What are the cons of growth investing? So generally speaking, growth investing is much higher risk than value or dividend investing. Now, with risk, there's going to be an expectation of an increased reward, and that is true. Generally speaking, you're going to have higher returns on an individual growth stock that does well versus an individual value stock that does well. The issue is balancing out the risk and the reward there. Another thing that I'm not as big of a fan of when it comes to looking for growth stocks is that the PE ratios are extremely high. PE ratios are a measure of a price of a stock versus the earnings per share of that stock. And if you want, I did a video 2 weeks ago. It'll be linked up here. Check that out if you want a more thorough explanation of PE ratios. But basically, what it comes down to is that they are more expensively priced relative to what their earnings are. And that in itself makes it a more risky investment because they're often at a higher price tag than what the company is currently worth. And generally speaking, you're just increasing risk, so keep that in mind. Another issue you have with growth stocks is that they oftentimes are not as diversified yet. And that's why some of them, like I said, may have potential, like they're a framework like Amazon, but if they're not as diversified, they're going to be much more fragile when it comes to an economic downturn or just a change in industry. So that's another thing to keep in mind. Regulations, like one paradigm shift in how business is able to be done can make or break a lot of small companies. Think of MJ stocks, because they were looking amazing investments a couple years ago, but right now they are not looking good at all. And a lot of that has to do with the expectations that investors had and how regulations would change and then how they didn't change. And so that's one thing to keep in mind. Another example would be companies like Zoom. Right now, everyone's looking at Zoom and they're thinking, man, this looks like a great growth stock because, right now everyone's staying at home. There's going to be widespread adoption because everyone's going to, try it out. They're going to see that they really like this and they're going to use it going forward. But Zoom has had some pretty big issues when it comes to their security, and that could be a real big problem because we definitely want to have security and confidence when we're having teleconferences. So things like that are very important to understand when you're looking into growth stocks because they can definitely hamper the ability of that stock to find its full potential. And then most pertinent to right now is growth stocks are often hurt the most during bear markets. This is because often they will increase debt in order to grow early on, and that can be a real issue when cash flows dries up in an economic downturn. Also, because there's less cash, that means investors are going to want to be less risky. They're going to want to keep more of their money and maybe lower their risk profiles. That means a lot of them are going to maybe pull out of more risky growth stocks and go into more safe dividend stocks or even bonds and cash. So that's another thing to keep in mind. Also, the growth story could change. As I just mentioned with Zoom right now has a really good looking growth story, but that's because of the specific nature of how the economic downturn we're currently in has happened. If you look at other companies that are small, not well diversified, and have quite a bit of debt, they're not going to have an easy time making it through a downturn. So you just got to keep in mind, when you're playing with risky stocks, then you're going to have more risk, and people want to take less risk in the bear markets. Now, I hope that gives you a better idea of what growth investing is and what growth stocks are. Obviously, your individual investment decisions are completely up to you and up to your particular risk tolerance and time horizon. So make sure to do your own research. Don't just, listen to what I have to say. Make sure that you understand before investing, and let me know in the comments which growth stocks you guys are buying or are interested in buying during this downturn. And if you are interested in getting started investing, be sure to check in the description box. There's a link for Webull, which is a stock trading platform that is commission free. They support Roth and traditional IRAs, which are great for people that are just getting started and trying to grow wealth for retirement. But what's really great about them is if you sign up with the link below, you'll get 2 free stocks when you sign up for it and when you deposit at least $100. So also let me know what free stocks you get. And I really like Webull because it's extremely well laid out. They have very good analysis tools where you can go and look up all these different things that I've been talking about, like earnings per share, ROE, debt to asset ratios. It's amazing to have all of that available on your phone and on a desktop app. So definitely check that out. And thank you guys for watching the video. We'll be talking about other styles of investing in the next couple videos. So be sure to check those out as well. Make sure to subscribe to the channel so you don't miss them. And I will see you guys next time.